Hey everyone, welcome back to our Demystifying Biotech series. Today, we'd like to pick up where we left off in our last video, where we talked about phase 1 through 3 clinical trials and what that means for investors. Click here if you haven't yet seen that video. So as mentioned, once a drug has completed clinical trials, it then has to apply for a NDA, or a new drug application, in order to be considered by the FDA. Now, if the FDA decides to make a ruling, then they'll set what's called a PDUFA date. That is to make the ultimate decision about whether a drug will be approved and marketed to the public. You might be thinking, well, if a drug passes its phase 3 trials, it hits its primary efficacy and safety endpoints, then surely the PDUFA date is a mere formality, right? That's actually not the case. There are various different situations in which the FDA has made somewhat surprise rulings on the PDUFA date. Now, before we get into how those rulings might differ, first just wanted to provide a little bit of a history lesson and some context around how the PDUFA date came into being. Now, PDUFA, or PDUFA, stands for the Prescription Drug User Fee Act. This was passed in 1992, and it was a response to the fact that the FDA was taking a really long time to approve drugs, and it was leading to a lot of hangups. Manufacturers were not happy, patients were not happy. So what this bill did is it allowed the FDA to charge for manufacturer to submit their new drug application. And that therefore allowed the FDA to hire more people, and it made that whole process a lot smoother. In exchange for that user fee, the FDA actually had to set a date and hold to it, more or less. So what happens before a PDUFA date leading up to the FDA's decision? Well, there are a couple of different factors. First of all, the FDA is, of course, going to review the safety and efficacy data and determine whether this really is an efficacious agent that is generally well tolerated among patients. They'll weigh the pros and cons of the trade-offs between efficacy and safety, ultimately make a ruling on that. But there are other factors that are involved here as well. For example, the FDA has to determine what's called the label, which means which patients is this drug actually supposed to be prescribed to. So based on the clinical trial data, the FDA will actually assign a group of patients. So we can think about, for example, there might be type 2 diabetes patients, and some might have certain comorbidities like heart disease. And so the label might indicate that this type 2 diabetes medication is contraindicated for patients with heart disease. So that's also part of the FDA's overall review process. There's also the facilities inspections. The FDA wants to make sure that whatever facilities are producing these drugs meet all of the different clinical grade qualities and are not going to cause any sort of supply issues once a drug actually goes to market. Now, believe it or not, once the FDA makes the decision on the PDUFA date, the story isn't always over. So oftentimes drugs will have to do what's called a phase 4 clinical trial. That is post-marketing, and it's where the manufacturer will follow the patients that are using these drugs, or will follow up on phase 3 trials and will have a long-term trial to track the growing evidence about how this drug is working and if there are any safety issues. So just because a drug has been marketed and gets approved on the PDUFA date doesn't mean that it's going to be on the market continuously. One example of this is a painkiller called Opana that was withdrawn back in 2017 due to safety concerns. One example of this is the painkiller drug called Opana, which was recalled in 2017 when it was determined that the benefits that seemed to be demonstrated during the clinical trials actually didn't outweigh the potential safety issues at hand. Now, again, in our last video, we also talked about how big of a driver those phase 3 clinical trial readouts can be for a biotech stock. They can really be make or break. So that might beg the question, if a company got good phase 3 results, they saw their stock skyrocket, Is that it? Is any PDUFA date approval already baked into those gains? The answer is not necessarily. There are different circumstances that might impact whether a company has even further to go should they get that coveted FDA approval during the PDUFA date. And that's because, as mentioned, just because you get past phase 3 does not mean that you're going to get the approval. So we'll talk about a couple of different scenarios in which approval was not guaranteed. Now, I want to talk about what a rejection looks like for the PDUFA date and from the FDA. This is usually called a CRL, which means a complete response letter. And this is basically the FDA saying, sorry, we took a look at your application. There are things that are askew, things that are wrong. Perhaps we need more data in order to make a determination. Now, yes, this is a rejection letter, but it doesn't mean that the drug is dead in the water quite yet. There are different types of CRLs, or complete response letters, that impact a stock's valuation and also impacts how investors should think about that FDA decision. So on the one hand, there is a request for more data. This is a common CRL in which the FDA feels like perhaps the readout for the data or the length of the clinical trial was not sufficient, and therefore requests that the company does a little bit more research and a little bit more clinical testing before the FDA makes their determination. One famous example of this is the recent BioMarin gene therapy that was rejected by the FDA with them asking for pretty significant additional data and longer readouts, longer duration readouts, in order to get a sense of whether this drug was actually working. Now, anyone who's interested can take a look at the BioMarin stock and see how big of an impact that had on their valuation. So these types of CRLs oftentimes mean a pretty significant stock hit and a pretty significant barrier that the company has to overcome in order to get that drug into the clinic, especially considering if, for example, an additional 2 years of data is required. This means a lot more expenses. This means greater chance for failure. This is really a pretty significant hit for the company. Now, on the other hand, there is the non-clinical CRL. This means that the FDA was generally pretty okay and satisfied with the efficacy and safety data that was presented, but there might be some non-clinical factors that need to be fixed before resubmission. So this could be things like perhaps their facilities weren't quite having all of the clinical grade quality that was required, and so the company needed to go and make sure their manufacturing process was squared away. One example of this is Heron Therapeutics, and they had a recent PDUFA date for their non-opioid painkiller that ultimately was rejected by the FDA through a non-clinical CRL. Now, this sent the stock tumbling around 30 to 40%. So this was a pretty big hit. But what we saw is that there was a fairly fast rebound even that same day or the following day for Heron Therapeutics, because the non-clinical CRL meant that the drug itself was working. So there weren't really any major foundational flaws with the drug itself. It was more the non-clinical factors, which are much easier to address. So what this means for investors is that you should pay attention to whether the CRL was clinical or non-clinical, because this is going to ultimately determine how that stock rebounds. And there may be an opportunity for seeing that waiting out after the initial shock and seeing the stock rebound. And it also positions the company much better for the next PDUFA date and FDA decision. So let's do a quick recap. PDUFA dates are set by the FDA. They're when the FDA makes a determination about whether a drug is going to be approved for marketing or not. The FDA is not only considering safety and efficacy data in their decision, but they're also taking into account non-clinical factors like the quality of the manufacturing process. If approved, a company's valuation is oftentimes impacted even when it seems like it was a fairly sure thing that they would gain that FDA approval, because there is always some doubt or some potential that the drug may be rejected, perhaps for clinical reasons in the case of BioMarin, or for non-clinical reasons like in the case of Heron Therapeutics. And if a drug does receive a CRL, make sure to pay attention what type of CRL that is. Is it a clinical or non-clinical CRL? If it's a clinical CRL, this is likely to impact the stock more severely and is also going to make it more challenging for this company to resubmit to the FDA and may cost them a year or more in additional clinical development and testing. All right, so that's all we've got for today. Thank you again, everyone, for joining in. Hope that you enjoyed this content. If you have any questions about CRLs, PDUFA dates, any other FDA decision making, anything like that, please leave us a comment down below. We'd love to hear from you guys. We'd love to hear about any other topics that you might find useful, particularly as a biotech investor. So for now, signing off. Thank you again, and we'll see you next time.
If you guys liked our video, don't forget to like, comment, and subscribe. Also, check out our website at www.wx.capital. We have a great subscription service that allows you to get real-time trades as well as market commentary, so you know exactly what's going on with stocks and you know exactly what we're trading and what the next hot stock pick is. See you guys around.